There's a real emphasis on lower burn and growing more efficiently. And so those folks are turning to debt because you can grow sustainably and you don't need to raise equity and dilute yourself. So we do every once in a while get an entrepreneur who is expecting like mortgage rate level interest rate. And that's not where venture debt pricing is. So just so everyone knows, the banks charge about 8 to 10%. And so we're not far above that. We charge about 15%, but you can't borrow money for your business at 3 or 4%. That doesn't exist. When the US Treasury is borrowing at 4, that's kind of where the market is these days.
But I think that's good insight to give people set some expectations.
Yeah.
And part of this, I think, is related to the valuations of these companies, right? So it's maybe not so much your financing, although there is obviously some correlation between a reasonable valuation and what might be borrowed. But could we get into the valuation conversation? Because in my experience, this is a place where CEOs, every one of their babies is beautiful, they tend to way overestimate where they fall in the range of current valuations. So I think we plan to talk a little bit about, public companies first and the IPO market, and then get into the private market where, we all operate more.
Yes. So that is the name of the game still to this day. Almost nobody we talk to is not thinking about valuation and an eventual exit, right? They're building this business to go sell it, usually. Eventually. It may not be, some are, we're going to sell it in 6 months. Many are, we want to sell it in 2 to 5 years, right? That's the thing. So valuation is top of mind and it's the end goal. And so, yeah, I always like to start the valuation conversation with the public market because it both from a liquidity standpoint of exits and IPOs that fund VCs who then can raise more rounds and funds and then can fund more startups. There's sort of that liquidity waterfall that drips all the way down that's important. And we're sort of in a drought right now. That's changing a little bit. Some IPOs recently, Figma and Mountain have IPO'd and Rubrik and Clavio last year, but it's still not the heady days of 2021 or even the stable good days of 2016 to 19. It's a little dry. And the PE firms have not been distributing cash back. They've not been able to exit their positions, exit their companies, and distribute money to LPs to raise subsequent rounds and fund more companies. So it's that waterfall and that liquidity thing is very important. And another thing to consider as you go out and raise, asking equity investors where they are in their fund. Do they have an active fund? Are they fresh with capital? Are they towards the end of a fund, et cetera? Something to consider. But so it starts with IPOs in the public market. Public market is around 6 times ARR. SaaS companies, if you're not familiar, tend to get valued as a multiple of ARR as opposed to a multiple of earnings. Most of them are burning cash and are not earning anything. They're mostly negative or break even. That's changed a bit over time as the sector has matured.